In this video, traders, we're going to look at insider buying or selling. Should we be following it? Stay tuned. Hey guys, very warm welcome to you. Okay, so insider trading isn't the illegal stuff. Yes, we know the illegal stuff goes on, but insider buying or selling has to be disclosed to the exchange, and we can see a list of it very, very easily on sites like finviz.com. But the question is, from traders and investors' perspective, is it something we want to follow or not? Let's look at the evidence. So studies out there do confirm that following insider buying gives you a superior return. In other words, if you follow insider buying, more often than not, the stock will increase. Now, the order of magnitude is going to be different, and we might have spells where the market was going up anyway. And so, do we rely on that in total? No, not really. But if you think about it from a logical perspective, right? The people inside the company know far more than any analyst, any kind of trader, any investor, because they're right at the coalface of what's going on. They can see what's going on. They can see what's happening in the future. They can see whether they potentially have got a pipeline full of work. They can see whether a big contract is falling apart, the relationships breaking down. All those things that are the warning signs of positive expectancy or negative expectancy, either revenue come in or revenue going out, are things that they can see beforehand, and they can act on that. They're entitled to. It's legal for them to act as long as there's a decent specific time between them buying or selling the shares and actually the information supposedly going public. They can't act on insider information. So for example, if they got a deal, they can't just suddenly go out there and buy massive amount of shares if they got a deal. However, if they're running a marketing campaign, say, and their pipeline is flowing full of leads, they might then think, well, the sales cycle for these leads is 6 to 9 months. That means, in a year's time, the books are going to look pretty good. I'm going to start buying stock because this campaign's working. We've hit the nail on the head. We've adjusted and tweaked our offering a little bit, and we seem to be getting more responsiveness. Now, that's not insider trading per se illegally, because he's just acting based on, information that could or could not. He's making a guess. He or she is making a guess as to how that will affect revenue. So there's a distinct difference between the two. But you can see how and why that would be a profitable decision. Now, do they always get it right? Of course not. In that example there, they may think, well, actually, yes, it's a pipeline's full, it's going to make a lot of money on this, but if it doesn't turn out that way, it might even be negative because they risked all that money on marketing and personnel, etc., etc. So it is not a silver bullet, guys, but I think there's a little bit of an edge here. And my take on this, so I'm probably jumping the gun a little bit, is to use this in conjunction with your existing strategy. So if you have an investment strategy that says, buy X when this happens, and you do that, you may add extra weight to the trade if insiders are buying before you've bought, or if they're buying during your trade, during the investment you've got in, maybe you'll add more, that kind of thing. Now, let's just quickly talk about sells before we talk about buys and some of the things to look at for buying. Sells, listen, if there's a sale, a big sale from one or two directors or one or two insiders sporadically, it doesn't mean the company's going bust. There's plenty of reasons people sell. They want to take some capital out and put it elsewhere. Could be tax things, could be to buy a house, anything like that. So we've got to be a little bit cautious. We don't read too much into it. Same with the buys, but specifically the sells as well. But if everyone's dumping, like a massive amount of directors are dumping and insiders are dumping stock regularly and consistently, then we might think, oh, you know what, there's something in the air there, we need to be careful of that. So that's sells, and I don't think there's a big enough signal in sells to be that much of a trigger, apart from when it's really extreme. But let's look at buys. And by the way, a good thing, it brings us very nicely into this, is looking at the volume of the buys. So what I mean by volume is really a combination of two things. The number of insiders buying. If you've got one insider buying a big amount, that perhaps is still bullish. It's still good. I mean, if they're prepared to put personal money into buying stock of the company, then you would say that's pretty bullish. But if you've got 3 or more insiders who are buying, and they're buying a decent amount, like the volume as well, we want to see multi-millions going in relative to the company's net worth, relative to the company's balance sheet, or market cap, should I say, relative to the director's expected net worth. So for the smaller caps, it might not be as much, but you get the idea. The order of magnitude's got to be high. It's got to be a commitment, and the more commitment you see from each individual and from a group, the stronger the signal. If all the big kind of insiders are buying decent clips of stock, then you know what, that's something to look at. Maybe there is something on the horizon. And yes, you can dig and you can look in and see if there's any specific reason why they might be doing that. and if there's nothing comes to light, but you think that maybe they're adjusting their strategy in marketing, and you can see if they're B2C, maybe you can see what they're doing out in the real world, you might think that actually that's working for them and it might be time to follow them. The other thing is the reason. Like I just alluded to a second ago, if there is some reason why, let's say we have a big B2C company that's changed strategy, they've changed the way they're approaching, they've rebranded, they've changed the offering, the product, the service, something like that, and we can see that, and we see that there's a lot of insider buying after maybe, you know, a little spell of that, we might think, hey, you know what, that means that that's probably working. They can see that there's flow coming in, and in kind of 9 months time to 12 months time, they're going to see the fruits of that change. So here we've got others and timings. In other words, this is really looking at the bigger picture of the chart and all the kind of macro events around it. So if the chart has been beaten up, say, and let's say, like I say, they've changed strategy dramatically, that might be a really good time to buy, because if directors are buying and the timing of it, the stock's been hammered down and directors are still committed and they're pushing money in, you would assume, not necessarily, but you would assume that they haven't just pushed and wasted money on something they think is going to go lower. If they think they're in for 2 more years worth of pain, then why would they buy the stock at 50p when it's likely going to be 20p in 18 months time? So there's that as well. It's looking at the timing of it. And even if it's on a bull run, guys, and it's a bull run, it perceives, you know, average value, and people are still buying, directors are still buying. They're not buying because they think it's going to go up by 10%. They're buying because they think this thing is going to absolutely rocket and it's seriously undervalued based on what it's going to be in the future. Or that's their theory. Now, don't forget, back to the initial point, we are just following someone's hunch here. They've got a far better hunch, far better data than we have, but they still could be wrong. So it's not an all-in job. Right, the other thing to look at, guys, is which insider. So if it's the CEO, if it's the CFO, those big kind of insiders, if they're buying and they're buying in big size, then that's far, far, far more of a big signal than perhaps others who don't have a day-to-day handle on what's going on. And the other thing to look at is smaller companies. It's a far better signal. So small to medium-sized companies, if you're seeing insider buying in those, that's a significantly better signal, because of course a smaller company, they probably can have a much easier handle on what's going on in each individual sector, or each individual department, should I say, like accounts and sales and marketing. Maybe they're all on one site, maybe it's not that big, and they can really get down into the actual trenches. Whereas, you know, a bigger company, they haven't got a clue what's going on. They've got 1,000 stores. They don't know what's going on in kind of 500 of those stores. They just get a report, and they normally will get a compiled report, because 1,000 stores report they can't see. Now I'm talking about a retail example here, but you get the point. If you are a software development business and you've got it worth like 50, 60 million, you're going to have, you know, a decent sized team, but you're going to know exactly what's going on probably with each individual project, exactly what's going on with the sales pipeline, all that kind of stuff. So smaller companies, the higher level insiders are better positioned. And you've got to remember that this is for longer term. The studies show that really it's over a 2-year cycle that this kind of thing comes to fruition. Now, is that too long? Well, you know, it's up for you to decide, but that just tends to be the data. Now, what we've got to bear in mind, guys, is that, you know, if the market goes up in that time, then this data is going to be skewed, because people might just be buying this stock and the whole market lifts the whole stock market. And also, let's not forget, it doesn't matter how good a company is doing. If the market is getting hammered in general, then that company will get hammered too. That's just the way it works. So the biggest signals we've got are the smaller company the better, a decent level of insider, CEO, CFO, a good volume of those, so a nice number of high level insiders in a small company, with a kind of reason behind it or story behind it. That's not necessarily always got to be there, but that'd be nice. And also in the volume, a decent clip each. There's no point in them just buying 10 grand worth of shares just to get the print on the thing to say they've bought. That's pretty irrelevant. One final thing before we go. You've got to be careful of any insider who says they're going to buy shares. There was a company a while ago, I forgot the name of the company. The CEO said he was going to buy $100 million worth of shares. He ended up buying way less than that. Of course, the market spiked when he announced that. He ended up buying way less than that. The market ended up lower after the period when he bought, because he'd hyped it up, and those people who followed that got hammered. So you're better off doing it based on actual buys and actual data, genuine buys that have come through and been reported. Like I say, finviz.com, good way to check out. Anyway, guys, that is following insider buying. Keep your risk managed, whatever you're up to. See you later. Bye-bye.